Welcome to the fifth Zoominar. Hope everyone can see. Welcome to the fifth Zoominar in our series of Zoominars, where Cornerstone Legal Law Services, Cornerstone Legal Services provides legal and financial tools to physicians, which is our way of making legal and financial tools understandable and accessible to all of you. We bring in experts to allow you an opportunity to learn from and ask questions from people who have extensive knowledge in financial areas that we know will be important to you. So I'm Safura Khan, an attorney from Cornerstone Law Services, and so the past few sessions we've had honor of hosting Mr. Don Gary, a tax attorney, and he's had very good things to talk about, like family limited partnerships, estate planning, entity formation, and I'm sure later he'll be joining us again, so make sure you take advantage and ask very important questions. But today we are being treated with the presence of Mr. Lam Jiang, and he has extensive knowledge in the area of insurance, and he's a financial professional, and he's had many years of experience, and he has licenses in many states that qualifies him to be a health and life insurance agent, financial advisor, investment advisor, and a fiduciary, among other things, broad spectrum of financial services. So I'm happy to say that he will be answering our questions and teaching us a lot of things about disability insurance, exit strategies, how to incentivize and retain employees, how to balance plans to maximize tax deductions for business owners, etc. So that's like amazing stuff that we will be learning today. And usually Dr. Sana is here to be our physician representative, but today we will let Lam speak to all of you and let all of you ask your questions. So please ask your questions in the Q&A section at the bottom, and we'll try to get to as many as possible. And the rest we will, you can email, and Hani will put the email, I'm sure, in the chat area, and we'll respond with the answers. And as usual, I would just like to emphasize that the purpose of these Zoominars are for educational purposes and not intended to be legal advice. And please contact a legal professional to develop a proper plan that's right for your personal situation. And I think Hani has something to say first, and then we'll...
Thank you. I'm really excited about today's topic and having Lam with us, but especially excited about the disability insurance topic. And Lam, I mean, as you know, I'm sure with the risks that are still posed by COVID-19, we all need to face the possibility that we could get sick. And, even if we take great care of ourselves through, good nutrition or sleep or exercise, and even if you don't need to be hospitalized, because even if you do experience symptoms and test positive, you might have to stay quarantined for enough time that you'd lose income. So, I mean, these risks highlight the need for everyone, regardless of their age or state of health, to have some form of disability insurance coverage to protect their earnings. And I mean, this is very, very important topic. And again, I just want to really because I mean, you might think you don't need disability insurance, specifically if you're young and in good health. I remember when I first got married with Noor, that's the first thing that she really wanted to get as soon as possible and put it in place, the disability insurance as an ophthalmologist and as a surgeon, because you don't know when you can become disabled. It could happen anytime to anyone. And it's really, so it's not really specific to coronavirus either. It has always been true. I was reading, according to the US government statistics, 1 in 4 20-year-olds become disabled before reaching retirement age. And the most important part of this, that you must get the actual disability insurance before something happens. If you're already sick, it's harder, as I anticipate, to buy disability insurance to make up for lost income. And Sephora, we've been talking about this. I mean, this is really similar to what we have been discussing in previous episodes, that you need to form asset protection structures before getting sued, because once you're sued, it's not going to work. And with that, I just leave it to you, Lam, because I know you have lots of things to cover and, explain to us more about today's topic. So thank you so much for being today with us.
Not a problem, and thank you for having me. And yes, all of the topics that we're going to talk about today are very highly important. And I love what you said too. You got to plan for it before, right? A lot of people ask, "Can I get it after?" It's kind of like asking a person for health insurance, say, "Oh, I just got diagnosed with cancer. Can I apply for health insurance now?" Right? Because I want the coverage, I want the benefit from that. And no, you have to get it ahead of time. And so most of life is like that as well. You don't get in a car accident first and then go try to find the company with the best benefits for the car accident and apply for it afterwards. So that being said, my name is Lam Jiang. And I know it's like everyone calls me Lam. That's okay too. You know, it's just phonetically how it looks. I'm Vietnamese, so that's the pronunciation for that. And today I'm very excited. I have a lot of topics to share with you guys. Unfortunately, we have a limited amount of time. So if there are extensive questions and things like that that you guys have, then we can always answer after the fact. I'm going to share all my contact information, and you know, our main role is to educate and to serve. So we'd love to answer all of your questions too, you know, if they come up. And so I'm going to share with you guys a little bit about my slides. And then just like Safira talked about, you know, we have multiple licenses. And just a little bit about myself. I run this business alongside with my wife. And we operate in multiple different states currently. And we are considered an independent broker. So what that means is we have access to over 180 companies right now, whether it's disability, whether it's on the financial side, wealth management side. We cover a lot of different areas, but there are a few topics, especially for this series, that Hani and Safira asked me to talk about. So I'm going to share with you the agenda for that. Share screen. All right, so let's jump into the topics for today. So again, you know, like today we're going to talk about minimizing financial loss in unplanned emergencies and utilizing investment vehicles to maximize tax deductions. And so there's a lot of fun topics that we're going to be able to talk about. And especially if you know, if you're in the medical field in any capacity, right? Physicians, dentists, pharmacists, and especially if you're a business owner as well, on top of that, then a lot of these things will be very pertinent to you. So first and foremost, let's talk about the agenda. So like Hani said, one of the main topics we're going to be covering today is the disability side. Very important topic. I will briefly also talk about key person insurance because that is important, especially if you own a business, shortly about that. And then also talk about business continuity and succession, or some people call it exit strategies. And if you don't have a plan in place, then it just makes it very difficult to financially recover from some of these situations, and also strategies for tax deductions as well. And I think everybody loves to save on taxes, right? So I'm going to get into some of those topics. So first, let's talk about disability insurance and not just health insurance. And if you have questions on health insurance for you, your company, and all that, we can also address that too, but today's topic is not on that. But when we talk about insurance, one of the first things that people think about is health and life. And even though we do that, right, these are things that people don't think about. And one of them is disability insurance. So disability insurance is basically the ability to protecting the ability to earn income, right, by you being able to actively work. And it's one of the biggest assets that you need to protect, right, because the ability for you to generate income. And so you'd be surprised that the majority of the claims come from these areas. And if I were to talk to you about disability, a lot of people would be thinking about, oh, you know, maybe I got into an accident, right? Maybe I got into a situation, right? But I'm going to share with you, when I uncover some of the top claims for a lot of you guys on this call, you'd be surprised where they're coming from, right? So 90% of the disability claims are actually on health conditions. Okay, 10% are on different accidents ones. And the number one health condition that is filed and claimed are back, spine, and neck degeneration. So this is the number one out of 90% of the disability claims. Number two are mental and nervous breakdowns. Number three, cancer, stroke, heart attacks, aneurysms. And number four, Alzheimer's and dementia. So the top four that I listed here make up about 90% of the disability claims out there. And that is something that people are not aware of. Where people are thinking that it might come from are the 10% of the claims: car wrecks, unexpected accidents, and sports incidents, right? So those are like, right, so maybe you work out, you play sports on the side and all that, and you get accidents and injuries, and sometimes it's not, for a lot of people, it's not enough to be a claim, right? So those are some stats that I wanted to share with you guys. Okay, so next, oops, here we go. Also, this is going to be pertinent for a lot of you guys on this call, okay? So 60 to 70% of all disability claims are coming from these top 3 professions. They're coming from doctors, dentists, and attorneys. Those are the top 3 for disability claims. So you might think they might come from construction workers or come from, blue collar workers. And yes, they do come from that area too, but 60 to 70% of the DI claims are from doctors, dentists, and attorneys. Why? Because number one, they have more income to protect. And that's just the basic averages. I'm not here to put down any specific profession, but I'm just saying that typically dentists, doctors, and attorneys get paid more. So the importance of protecting the income is higher weighted, right? So imagine, a doctor and dentist, some of them making $200,000, $300,000, $400,000, $500,000. And guess what? That's a lot more that you want to protect. And number two is a lot of these professions, they have their own practice. They have their own firm, they have their own practice, and they don't have any group coverage. I'm also going to talk about group coverage as well, because a lot of people will say, oh, well, I have group coverage, it's enough. And that might be a misconception that I am going to address as well. So not only do they not have group coverage, but sometimes group coverage is not enough. So they have supplemental on top of their group coverage. And that's why we typically see it in those professions. Now, let's compare to some of the general disability companies that we've seen out there. Again, like I said, we're independent, so we can research through multiple carriers to find out something that's specific to doctors, nurses, and medical field professions and all that. And so the ability to be able to decipher that is difficult for some people, and they might just Google disability and buy the cheapest one that they see on there. Well, sometimes you get what you pay for, right? So I want to share with you guys a little bit of idea behind it. But at the end of the day, you don't need to be the expert in it, but at least you have the knowledge of it so that you know what to ask, or you can allow us to go out there and do the research for you, right? So that's what value we can provide for families and businesses. So on the disability insurance side, a lot of the general disabilities are right here, short-term, and that one is, for example, sometimes some of them covers less than a year or 1 year, and for a lot of our clients, it's not enough. So they're looking for something a lot longer, right? And also they're inexpensive, right? So you'll see like, wow, I'm gonna just buy the cheapest one on the list, right? But at the same time, you got to be careful, because you got to know what it covers and what it doesn't cover. And a lot of them don't have pure occupation definitions. That's also very important for you to be aware of, right? So that you can be careful, because pure occupation definition means, let's say that you are a doctor, you are a physician, you get injured, right? The disability might not pay out because they're going to look at your injury and they say, well, you're not, you can't perform your own profession, but you can go out there, you can drive Uber. Oh, you can go out there and you can work another profession. Right? So, and since you can make money doing that profession, then we're going to pay you less, or we're not going to pay out at all. And so just be careful with that as well. And so when we're working with white collar workers, we're working with doctors, dentists, we want to make sure that we have peer own occupation definitions in there. So if you cannot perform your own occupation, it will pay out. I hope that makes sense, right? Next, a lot of people talk about group plans from work. Group plans from work. So group plans from work are, for example, taxable, right? So this is different than the ones that I work with, right? Because the ones that we work on the individual basis, the ones that we work on our carriers, are non-taxable, okay? So first and foremost, just keep in mind that it's taxable because the benefit that you're getting is not the net benefit, right? The majority of the group plans that I see out there, if the employer is paying for your coverage, then it is taxable. If you are paying for your coverage, then it's a chance that it's not taxable. Also, the group plans from work have a maximum cap. These are the two typical maximum caps, which is $10,000 a month coverage and $5,000 a month coverage. So that's another area that you have to be careful in as well. So for a lot of people out there that are making 200, 300,000 and they're used to having a higher income, and this might not be sufficient, right, for their needs, for their family. And so that's another area to pay attention to. And last but not least, they're not portable. Portable meaning if you ever get laid off or you go out to open up your own practice and you're no longer working for them, then you cannot carry it with you. That's why we call it portable, right? So that is group plans from work. Now, a lot of the carriers that I select from, we make sure that we select from carriers that are specific for the needs of our clients and the families and the businesses that we work for. The coverage is 60% of the income, and it's gross income. 60% of the gross income. So if somebody is making 300,000 a year, then the coverage will be for 180,000, right? And that's effectively close to 90% of the net income, because don't forget, we're calculating that from the gross, and after this person pays taxes, right? So we're trying to reach a portion of the net income. Also, a lot of people ask about costs, and I didn't have it on the slide because the cost can range, right? We have to run quotes for you and all that cost, but our goal is to keep the cost at about 2% of your gross income. So, for example, if your gross income is 100,000 a year, we're trying to minimize the cost to about 2,000 a year. If your gross income is 300,000 a year, so we're trying to get the cost down to about 2%. Okay, 2% of that. And so that way, we don't want it to break the bank, but we know that the coverage is important as well. Also, instead of having short-term coverage, we're looking for longer-term coverage, 2 to 5 years coverage. And these are some things that we add on here as well. Because they're individual and you pay for your own, it's also non-taxable. Okay, so that's also very important because after you collect the benefits and, so non-taxable as well in terms of the benefit distributions. And these are things that we typically have on younger clients as well. It's called cost of living adjustment because they might have like a younger age, right? Like, so they're getting Henny mentioned, oh, I'm young, I don't need this, right? So they might be 30 years old. So by the time they need it, it might be a higher amount, right? So you can have a cost of living adjustment. There's also one feature that we add on there too, especially for younger one, now that you mentioned it, that allows you to purchase future benefits, right? So you don't have to go through the underwriting again. You don't have to get approved again. So let's say that you're 30 years old, then we can actually add on something that calls a future purchase plan that allows you to purchase it in the future when you're making more income. So it's very typical of a case where, let's say that you have a physician who just got out of residency. They're just starting the practice. Their income is kind of low, right? So they're making 100,000 a year, for example, right? But they expect to make 300 or 400 or 500,000 down the line in 5 to 10 years. You can add something on there called a future purchase rider, right? That allows you to purchase additional coverage for disability without going through the entire process again. So we can add that on there for your younger clients. That is available. And last but not least, we have this peer-owned occupation definitions, which is very important, especially if you're gonna have this type of coverage. You got to be careful about if the company is going to go back at you and saying, oh, you can work another profession, oh, you can work another job, and so therefore we're going to reduce or not give you the benefits. And I think that's important to understand that exists. Okay, so that's a little bit on the disability side. So for those of you on this call who say, you know what, can you take a look at, how much it would cost for me and all that? Yes, so we run, and I'm going to mention this at the very end too. Everything that we do, quotes, and we can run the numbers and all that, is free of charge. We can take a look and we can actually adjust it as well. We can work on people's budgets. So don't let cost be a factor, that because the cost of not having it, we've seen, is a lot higher than just doing the annuals as well. Another one that we talk about beyond health insurance is key person insurance. And key person insurance is the success of a business may actually depend upon an individual, right? You might be a key executive or an individual and all that. And so this is specifically for somebody who owns, for example, a practice, and you're hiring employees and you have a few people that that if they die or they're disabled, they're no longer able to work for you for a certain period of time, or if they die, they pass away, your business is at risk of losing a large amount of revenue. And that's where this key person insurance comes in, and it's very important to have that, you know, for your business, because some of the main reasons for people to have this on this type of insurance on their key executives is number one, you cannot sustain the operations, right? So let's say that you own a practice and you have one key doctor that is working for you, and if he's out of commission and he's not working, then your business suffers. You lose half the revenue. Then that might be a good case for you to start looking into key person insurance. Or you have a top CEO, you know, that you really rely on for his brains, or, you know, his work that he's providing for the company. That's number one. Number two, business continuity is a big concern for you, right? So in the case that they're unable to work, or you're going to hire somebody else, then you need to leverage a lot of the resources for that as well, right? So you can actually have a key person insurance that that pays out during this time, so that you can actually continue the business, or hire someone to continue the business in his place. And future growth or financing needs. So what do I mean by that is, a lot of times when a business needs financing, right, crediting, financing, loans, they will also look to see if you have key person insurance in place on top of your key people that makes the business operational, because they want to make sure that the business is stable. So this also represents business stability in case of worst case scenario. So they want to make sure that that is in place. Okay, so that's very important to talk about. Again, the idea of today is to highlight different topics and highlight different areas that you may or may not have been aware of, so that you can actually ask more questions, so that it opens up your eyes to start looking into some of these areas. And so today is not for you to become the expert, right? Allow us to be the expert, allow us to do the research for you. But it all starts with you knowing that it is a problem, a cause of concern, and then we can start taking a look into it. So that's why, you know, I apologize if some of these topics are a little bit brief, but it's important to share with you guys the key concepts, so that we can kind of cover all the different areas that we're going to be discussing today. The next area that I want to jump into is having a business continuity and exit strategy, exit plan. And the cost of not having a plan is a lot of people go through life and they own a business, but they don't like to think about one day I'm no longer going to have the business. They don't like to think about that, because they love, right? Because they don't like to have the idea that the business is not going to be there for them. But not having a plan is going to have a huge cost, maybe financially, right? Hope is not a strategy as well, right? So you hope that the business does well, but in case it doesn't do well, or in case ABC doesn't pan out, you know, what's your exit strategy? So let's talk about the cost of not having a plan. Number one is, one of the costs is the business owner was hoping that the business is going to fund their retirement, is going to be there for them during their retirement, or the buyout of the next owner is going to start funding their retirement. And I've met a lot of business owners who talk about that. They don't really have a formal, you know, plan, right? They're not employees. They don't have a formal 401k or an IRA or whatever the case is, a pension plan and all that. And they've invested most of their assets into the business, and then they are banking on the business generating that income during retirement, or they're banking on the sale of the business to generate income during their retirement. But we've seen that if you don't have a plan, a solid plan with contingencies and backup and emergencies, right? as a financial advisor, planner, and strategist, so what I typically do is I like to plan for the worst case scenario. What if? What if it doesn't pan out the way that you had in your mind? So same thing with retirement, same thing with your investments. What if the market doesn't perform the way that you want it to perform, right? What if some of these things don't pan out? Do you have a contingency plan? And that's what we provide, right? In all aspects, whether it is the business side, whether it's a personal side, the way that I approach families and all that is, I like to plan that even the worst case scenario, we're covered for that, right? So first and foremost is we've seen that these business owners bank on the business being there, but knock on wood, something happens and they actually have to unretire. They actually have to go back to work. And I think that's unfortunate. I think that's very sad because you've worked very hard to get to a point where you can retire, then you deserve to enjoy it. And that's just my own personal opinion. I think you should be able to not stress out and not have to go back to work financially. So that's first and foremost the cost of not having a plan. Number two,
and I'm sorry to cut you off, but even in you cannot come back to work, upon death or capacity. That's even a bad situation as well.
Absolutely. And Hani, feel free to interject anytime, right? So sometimes I get so fired up about some of the topics, I'm like blabbering away. But you're absolutely right. And sometimes maybe you're 78, maybe you're 80 years old, and physically or mentally, you're not even able to work, but you need the income. So, especially in my culture, the kids kind of take care of their parents, right? And so I think like that's not like an ideal situation where you feel that you're a burden on your family, right? Where you don't have income and you're moving in with your kids, right? And they have a family to take care of and all that. And they're also taking care of you. And at any cost, we don't want to be a burden for them. And we just want them to succeed and go through life and all that and not be a financial burden for them. And so for me, that is not a good contingency plan. I like to have a plan that is in place where what if that happens, you're covered. And we're going to talk about that. Number two, potential fire sale of a business when there's no solid game plan to sell the business. So a lot of people, they get into situations where they're desperate, and even though the business is worth 3 million or 2 million, they kind of sell it at right, because they're so desperate for the funding. Nobody's buying, nobody's running the business. And they want to retire, and they end up having to sell it for 1 million or 500,000, right? It's not the amount that they originally had in their mind, but nobody, right? They don't have a potential buyers at the right time, at the right place for them to exit smoothly. And we want to help with that smooth, transition. And you go, well, how does that work? Well, we're going to talk about that, right?
Because as physicians, you can't really even partner with non-physicians, and it makes it very difficult to, like Sana mentioned in our last session, he was talking about a doctor the husband of a doctor who passed away, and she had a very successful practice going on, and they were looking for someone to buy this practice, but just approaching all the doctors, and it was difficult for them. So.
Oh, thank you for adding that. That's that's real life situation, and I think that's even more powerful than just me sharing stuff and concepts and theories on the screen. The more powerful ones are what people are actually going through. So when stories pop up like that, please interject and add that in there. And that's very common. I'm going to share other stories too that are very common where, a very common scenario is like, you have two partners, right? And one partner pass away, and then automatically those shares go to the spouse, right? So the spouse owns the shares of the business, but are unable to perform in the business because she's not licensed, she's not certified, she's not a doctor, she might have another profession, right? And so, but she is still technically owners of half of the shares. And so what you're gonna have is you have a case where one partner is doing 100% of the work, but the spouse is collecting 50% of the benefit, and everyone's gonna say that's not fair. Right? But at the end of the day, that happens in real life. And so without a contingency plan, without having plans in place, these are the unforeseen things that business owners will go through, and it's a headache. And you can go months and months without generating profits and revenues, and it can be a headache without a game plan. Right? So I'm glad that Dr. Sena had, different people that went through that scenarios and situation, because it's happening. Also, potential tax consequences when businesses has no choice but to dissolve, right? So I'm not a tax. So everything that we talk about here, I am on the financial aspects, the investment aspects, right? So I'm not a CPA, I'm not a tax accountant. So we highly advise you anything that is a specific tax question with specific dollar amounts or calculations to talk to, your CPA and all that. And gladly with Cornerstone and all that, they have their own, CPAs and all that they're going to recommend and direct you to. So it makes it very easy, right? Which is great. So there's already those people in place.
Before I mentioned Dr. Senna, and Dr. Senna showed up.
Well, I heard you guys talking behind my back. That's what I heard.
Oh my God! Oh my
I
goodness!
was like, wait a minute. I mean, she quoted me correctly. Dare I say otherwise? Yeah, no, actually, that example, Lamb was. This is just a couple of months ago.
Wow.
There was so much desperation. It was the husband to try to find another doctor to take over his wife's practice. She was actually a solo practitioner. She was not in a partnership.
Wow.
And it's not a unique situation. I mean, we see this stuff all the time. Doctors generally don't think about what would happen if something unfortunate like that happens. What would happen in their practice to their family, right? Because there's a value in that business, right? There's a great value in that business. It's making a couple of $1 million a year, actually.
Yes.
And that has a multiplier of 4 or 5, so that's probably worth the $8-10 million practice. But just like that, gone. And so that value never got passed on to her family.
Wow.
And just really, there was a lot of suffering involved with that. Plus, the fact was that they were using that money for their expenses, their home, their children, private school, blah, blah, blah. The life just got turned completely upside down. And it's very difficult for another physician to come in and step right into that kind of those shoes, because they don't know what's behind the curtain. And, it may be perfectly pristinely clean, but unless you, go through due diligence, you don't know. So no one can just come in and take over a practice. So it doesn't work like that. But we see that not uncommonly, particularly when there's sole ownership of the medical people. So, anyway.
Absolutely. Yeah, thank you for that too. And that just happened recently.
Yeah.
Oh my goodness.
A couple of months ago.
And like you said, it's not very uncommon, like people just don't think about these scenarios because it's not fun to think of these scenarios, but that doesn't mean that you close your eyes to the scenario and just hope for the best. And there's a famous quote that people don't plan to fail, they just simply fail to plan, right? And with proper planning in every aspect of your life. And that's why we love what we do, right? Because we're looking at a family and the business and all that. We love to cover all the bases, all the different scenarios of disasters, all the different, complications that can happen in life and might happen in life. And then having the ability to protect assets, having the ability to, be prepared for any situation, whatever the case is, financially and all that as well, it makes us feel good about that, because when it happens, when it actually happens and they're reaping the benefits from it, they say, oh, we're so grateful. We're so blessed to be in that situation where we prepared, right? And so those of you guys on this call too, you might know somebody else who is going through the situation or might need to know this. So this is great for, we'd appreciate it if you let them know what you learned today as well, all right? So next one, okay, I'm gonna move on, right? Because I'm running out of time to have a lot of good stuff.
Lam, we also have all these webinars recorded. So if anyone wants this to be recorded, a copy of this recorded webinar, just email me and I will post my email right now and we can forward that. So
that is great. That is great, because I'm pretty sure that there's going to be a lot of people that wish that they had someone on this call. I actually had a text coming from one of the doctors that was going to be on this call too, and then he said, unfortunately, I'm going to have 2 more patients I'm seeing, and I'm stuck in the office, and he owns his own practice and all that, and he wished he could be here, so we can send it to him too.
Well, I'm going off camera, but I'm watching you guys, okay? Just be careful what you say.
Good to see you, Dr. Senna.
Yeah.
All right. Okay. Please interject with you have some stories coming up.
I'll come right back in. No problem.
All right. So next one I want to mention is potential tax consequences when the business has no choice but to dissolve. So, we've also seen cases where there is no other choice where they say, you know what, I don't want to run the business, I don't want to have profits, and we can't really run this business, and the business, and then basically they shut down the business, right? And there's a lot of consequences to that, including the tax consequences and loss of income, a lot of these things going on as well. So that is also cost of not having a plan. Another area that we want to talk about are top executives leaving for the company. So if you own a business, you own a practice, and you have your key guys, your key doctors, your key people in the business, they might potentially leave for another company because they have better benefits, they have better pay, whatever the case is. And business owners are always looking for a golden handcuff, right? Like something that gives them an incentive to stay with you lifetime, right? And last but not least, the potential loss of tax deductions that are available. There are a lot of tax deductions available for business owners that if you don't go and do an analysis or a thorough analysis, you know, through multiple different third-party administrators and actuaries and TPAs and CPAs, and we actually help to provide for that, then you might be missing out, right? The money is reported as a profit, and you could have actually deducted a portion of it, and it goes towards, like, for example, an investment account that you can reap the benefit. Why have the money go towards the IRS when some of that money could have been tax deductible to you and goes to your own account, right? So we're going to talk about some of the strategies going forward for the rest of this presentation. Here you go. So next. All right. So let's talk a little bit about business succession planning. Traditional business succession planning, and if you're working with someone who's been doing this for a while too, hopefully they've updated some of their succession planning. But the one that traditionally trained, classically trained advisors talk about is setting up a buy-sell arrangement and adding a term life insurance in case your partner dies, right? And they will add the term life to be 20, 30 years that the business is expected to be ran. And that's okay. I'm not saying it's bad. But you know, the comprehensive type of plannings that we do also covers other scenarios. What if your partner doesn't die? What if your partner just wants to retire? What if your partner wants to, you know, sell his portion 5 years in, right? So we talk about a comprehensive plan being more of like a funded buy-sell arrangement versus just a buy-sell plus term, right? That's the traditional type. So I'm going to get into a version called a funded buy-sell arrangement. So they cover a lot of different scenarios like disability, like retirement, transitioning your business shares to other partners, right? So let's say you have a group of 5 partners and you want to exit. How do you transition your shares to the other 4 to buy you out, right? And where is the money coming from? Like, what if they don't have liquid money available, right? What if they reinvest their money, or they don't have the large amount of money that it takes to buy you out, right? Transitioning a business to non-owners is another category as well. Transitioning a business, so let's say, for example, you are the sole owner of a business, and you have a key executive that you know that they may be interested in purchasing your business, and you don't have any heirs to pass it down to, right? Transitioning to your kids, your heirs, right? So there are so many different scenarios that if you don't pre-plan in advance, then it gets really messy on the back end. And by, you know, working with us at an earlier stage, it really allows you to go in there and properly plan it out and also smoothly transition. So let's talk about some of the customized approach that we have. And this is the area that gets a little bit hazy, only because every single business, the way it's set up, the way it's organized, will lead to a slightly different solution. And so that's why I can't sit here and talk to you about, you know, all the combinations and permutations. You guys are doing math and all that, right? Of all like the different combinations of types, which leads to different types of scenarios, because there's going to be hundreds, maybe even thousands of different outputs, right? So here are some typical or some examples of why it might be different, because some of these buy-sell arrangements use the business dollars to fund it, right? Meaning the business profits, the business dollars, not the money that's paid to your to the key people, the owners. Some of them use the personal money. So some of the buy-sell arrangements use the personal money of the business owners and all that, right? And some of the arrangement use loans as well, loans from banks, loans from other sources as well to fund the buy-sell arrangement. And which one is best for your business? There is no right or wrong answer, but it depends on all these factors. Number two, some are tax deductible, some are not tax deductible, right? And that is important too, because if you can save money, that's great. Some have a full basis increase, some do not. And so that's also important because sometimes, you know, you have 5 owners, they all put 100,000 to start up the business, right? But the business grows to a $3 million, a $5 million, a $10 million business, and that is basically like a gain, right? So sometimes, you know, when you're transferring or transitioning the business out, that gain might be taxable, or sometimes that it might not be taxable because you actually get to step up to the full basis when you transfer it out. And so every single type of arrangement that we do is going to differ, right? And of course, we're going to go with the one that share with you that benefits you the most. Also, what it depends on, multiple factors. How many business owners? Because one strategy is good for 2 owners versus 3 owners, 3 versus 4 versus 5 owners versus 1 owner, right? What's the corporate structure? Is it LLC? Is it S Corp? Is it C Corp? Like whatever the structure of the business is also a huge factor in which direction that we're going to go towards, right? And also, this is where it throws all the formulas and equations off, is what are the goals of the owners? Every single business owner may or may not have a different goal. And this is where, you know, we factor that in. One owner might want to retire, or you have 5 owners and all 5 owners want to retire, or you have 3 owners and 2 of them want to retire. 1 wants to keep it and pass it down to their heirs, right? And so every single scenario is going to be a little bit different. And so by sitting down and getting to know a business owner and all the different scenarios, the goals, the outcomes, the structure, and everything that is, right, like collecting the knowledge. What we do is we run a feasibility report, and we actually go through and we kind of see what the best output is. And just because we ran the best output doesn't mean you have to go with it, right? And we just want to show you what it looks like, and then we can adjust and design it along with you. And that's our goal, is to get you a customized approach where you're happy with that, and have your business go through smoothly. So I'm going to run through a few case studies, a little bit more advanced ones, so you guys get an idea of how complicated this may or may not be, but that there are solutions out there, right? So here's an example of John. I mean, we just put a random name in because we're not allowed to share clients' information. John is 55 years old. He has a family business, and he actually has 2 adult children involved in the business, right? So his 2 kids are running the business with him, right? But he doesn't have any other savings or significant savings for retirement. He's banking on the fact that when he retires in about 10 years at the age of 65, and the value of the business is projected to be about $3 million, then he wants to transition that to his kids, right? So that's a business buyout. Now, let's share with a little bit of a problem. Well, first and foremost, a $3 million buyout in one shot for the kids is not reasonable, right? They have to have $3 million liquid assets to buy out the dad. That's not a typical case, right? And so there could be a structured buyout in terms of time, which is like a 15-year buyout, and an estimated amount. And again, this will go through your CPAs and tax accountants and all that. This is not on my side of it, but I'm giving you the example of the case scenario. A 15-year buyout is estimated to be $245,000 a year required from business assets. What does that mean? It means that the business is slowly paying the dad $245,000 a year. He will use that towards his retirement, but every single $245,000 is used to buy his shares of his portions of the business, right? And so slowly the business is going to be bought out by the 2 kids, right? So that they're going to be the 2 owners of it. Utilizing the business assets of $245,000. Part of that comes from the profit of the business, right? So let's say that the business profit is about $1 million a year. They're going to pay themselves a salary. Part of the money is reinvested, and part of it is used to buy out the dad, and the rest of it goes to taxes, etc. Right? So that's an example. Now, here's the question. that 245 is actually a huge financial burden on their kids, right? How big is that burden on top of their own salaries, right? Because they have to make sure that the business is profitable, and they have to set aside another 245 to buy the data. That is a problem, right? Because also, what happens if the business goes under? What happens if the business dies down? Remember, he was banking on the business buyout to fund his retirement, which is the 245 a year, right? What if the business doesn't even generate a positive revenue? What's his retirement going to look like? So these are potential problems that we want to help to alleviate or fix or make better, right? So solutions, for example, and this is a little bit of a more advanced design. The purpose of today is not to get you guys to be the expert of how these advanced designs work. The purpose of today is to show you that there are solutions that we can help, that we can actually go through and do all these combination programs and all that. So this is a solution for this specific case. It's called an installment buyout with a defined benefit plan. And so how it works is, John has another 10 years, right? So of working. So during those 10 years of working, we're going to design a defined benefit plan that is actually tax deductible business dollars funding it as well, right? So money that was going to earmark, towards the IRS, we're going to use that as a deductible going towards this plan. He's going to do 120 a year for 10 years, and that's going to generate and estimate 1.5 million for his retirement. So automatically that already knocks out 1.5, okay, for John's retirement. What if the business goes down under? Well, guess what? 1.5 is already there at age 65. So before us working with John, if the entire business shut down at age 65, his entire retirement is gone, right? In this example, we are already giving at minimum 1.5 million for John's retirement. So that's good, right? So that's a game plan. Right. Number two is now the remaining buyout is not 3 million, it's 1.5 million. So that calculates to roughly half the amount that they were projected to do. So imagine now that the kids are running the business, instead of having a 245 liability that they have to pay out to the dad, right now it's 120,000 a year for 15 years, which is more reasonable, for them. Again, is that still susceptible to business going out? Yes, of course, but that's why, we also generate that 1.5 for John's retirement. If he doesn't like that plan, we can structure another plan. So there's a lot of different things that we can do. And I just want to share with you an idea, a concept that there are possibilities and solutions, and we're working on that. We designed that for the families out there. Number two, here's another case study, okay? So we have a 60-year-old sole owner of a business and does not have heirs, does not have kids that he has in mind to pass, or maybe the kids has no interest in the business. They have their own profession. They don't want to run the dad's business, right? Maybe the dad's a doctor, the kids are, real estate agents or whatever the case is, and they have no interest in the business. And so the main possible buyers that he has is maybe he is a sole owner of the practice, right? But he does hire a few other doctors to work under him. They're not owners, right? But they're running the business. They already have the clientele, the patients and all that, and they want to continue. Well, guess what? Here is a case study that we can allow to help. Let me share with you a problem as well. There's a couple problems, okay? Number one, his key executive may not have enough money to buy the business when Tom retires, right? So you're assuming that, Tom's going to retire and he's going to retire off the amount and he doesn't want to run the business. And now his top doctor has enough money to buy him out. Right? That's not always the case, right? So that's number one problem. Number two problem is his key executive may leave for a company while they're working. So let's say during the time that they're still working together, another company lures his key guy out and says, hey, work for me, I'll give you more benefits. Or, we're going to give you A, B, C, D, E that Tom's not giving you, right? So solution. Well, guess what? We can do something where we're using business dollars, again, not from your own pocket, but from the business dollars, to fund what we call and there's going to be a lot of terminology. Don't freak out. There's so many different plans out there. I can probably throw a list of 100 combinations of all these terms, and it doesn't do you any good. But this specific one is called a one-way buy-sell agreement in a SERP. Okay, I'm like speaking different language, right? It's a supplemental executive retirement plan. So this one has a specific vesting schedule. It incentivizes the executive to stay with the company. So, and also when the business owner retires, that plan actually builds up cash in it to help him with the payout. So give you an example. Let's say Tom has a worker named Amy, okay? And Amy is one of the top doctors, and Tom wants Amy to stay. So he is going to create a one-way buy-sell agreement where at the end of the day, Amy is going to buy out the business for Tom. But we're also using business dollars currently, right, as like treated like a bonus, right? So he's creating a bonus right now that is going to incentivize her to stay. Hey, Amy, if you stay, then this bonus is going to accumulate. And then you're going to be able to use this amount to buy me out as well, right? And so, and buy my shares. And then, so Tom gets to retire, his shares get sold, right? And then Amy actually is able to have the assets to be able to purchase them out through this program. And it's an incentive for her to stay. She's not going to go to the competitor. She's not going to leave the company. And she feels good about staying and actually running the business, and actually incentivizes her to make the business even more profitable, right? So these are solutions, and there's a lot of little nuances and details that you can adjust and tweak. It doesn't have to look like this. It doesn't have to be, this certain way, but here's just an example of a concept that we were able to help, this specific client out with, right? To incentivize. So here are some key questions that you want to ask yourself. Are you mainly relying on your business to fund your retirement? Okay. And a lot of people, the answer is yes, right? They're banking on the fact that the business is going to be sold to fund the retirement, or it's going to be there and running to generate income for the retirement. But is that a sure shot solution? Can you guarantee that you can retire comfortably without stress, right? Also, do you have a game plan to transition your business? And are you certain that the assets will be readily available to transition assets? The buyer or whoever you transition it to, are the assets readily available? What if we can create those assets for them, right? And if key executives leave your business for another company, will the value of your business decline? And I think that is important, because a lot of people, they're banking on the fact that, hey, you know what, that's my top guy, but what if he or she leaves, right? And so what if there are plans in place to keep them, right? And that will avoid a lot of problems. Okay. Last but not least, I know I'm running out of time, but I think like these are all very important topics. The last topic that we're going to talk about, which is one of the most fun topics, that is the tax deductions, right? Because if there's ways that you can have more dollars go towards you versus the IRS versus Uncle Sam, right? Are you open-minded to learn about those strategies? And so, so here it's just a sample business, okay? It's not anything specific, but a sample business where you have two people who are co-owners of the business, a 55-year-old and a 30-year-old. They're co-owners of this business, right? And they have other workers and all that, and they can have other workers, but these are the two top executives. Now, a lot of people have heard some of the more common plans out there, like a 401k plan, like a profit sharing plan, right? Which is great. But what we do is we run a thorough report, okay? So here's what we do. We have the business share with us a list of their employees, the census report of how much income they all make, how much the top executives make, how much the owners make, right? And we try to uncover tax deductions and future tax savings that the person might not have. And it's all free for you, right? So if we run that report for you and it doesn't look like it's there's any more deductions, then that's fine, right? No big deal. You move on with life, right? But 9 times out of 10, we found that there's a lot of areas that we've started to uncover that will benefit the businesses, where now more of the money goes into their own pockets versus the money going towards the IRS. So let's give you an example. So this is let's say that this is a business, 2 of the owners, and their annual revenue is $1 million, right? Now, not all of the 1 million is going to be taken out as salary, right? So part of it will come out as salary, 250, 80 comes out as salary, for example, right? Maybe this is a brand new doctor on the block and he's not making as much, right? And whatever relationship or plan that they have, right? This person makes a little bit more or a lot more. And now some of this money reinvest in the business, right? Reinvest in the business. for example, right? But the rest of the amount that is not deductible is going to go towards report it to the IRS, right? And so that's going to be taxable. Now, what is the maximum amount that we can deduct for this business? Well, we ran a feasibility report on this one, and we found that out of the remaining profits, the owners can deduct an additional $430,000 that would have been reported to the IRS. They can take that out of their profits into their own investment accounts. And they don't have to do all 430. They can do 200, they can do 100, they can do whatever amount. And so in this example, right, we split this into all the possible combinations that we can think of to actually get these business owners the maximum amount of deductions, right? And there are certain strategies that some companies will not even add as part of the program, but we added to the program that they have never thought about. One of them is this cash balance plan that a lot of companies are not aware of, that adds this life insurance premium in here. Now, why is this significant? This is significant because I'm circling the category because all the rest of this 401k here, this profit sharing here. Yes, it's good to defer taxes now, but when they retire, and even this this pension plan. So this is a pension plan. So here, let me erase this. Okay, this plan after tax conversion will be taxable, so it's not deductible. So let me cross this out. This is not deductible, and then it's already taxed, so we're not going to talk about that. So this 401k plan, this profit share plan, this pension plan, yes, you are getting tax deductions now, okay? And yes, you're deferring taxes, right? But what happens when you retire and you start withdrawing money? It becomes taxable. So you guys know that, right? From a 401k, from a profit sharing, from a defined benefit plan, that becomes taxable later on. Currently, it's tax deferred. Now, this is one area that we're unable to unlock that is tax deferred, okay, which is so far so good. But by utilizing certain strategies, you can actually have tax-free distributions as well. Okay, and this is only in the area of business owners. So most people think of taxes as either you get taxed up front, like a Roth IRA, right? You get taxed up front, but not on the back end, or you get taxed on the back end, like a 401k. You don't pay taxes here. This is one of the few areas that we're able to uncover, and unfortunately, a lot of businesses are not using this, right? That you can actually have something that is not taxed up front, is tax deductible for the company, but on the distributions, it's also tax-free. And this is something that we can design, but it has to be designed properly and transition out of the pension plan properly as well. And that's where we come in to help guide you along the way. And again, you know, like we run all these numbers through CPAs and TPAs and all that too. I don't do the calculations. I'm not the actuary. Right? Like my role is the investment side of it. And that's where my licenses lie. But luckily for you guys on this call, we all work together as a team in order to provide these benefits for the clients out there. So I just spent a lot of time on this slide because I wanted to share and highlight some of these areas that a lot of these businesses are getting deductions from. Again, the main purpose is not for you to become the expert. The main purpose is for you to become aware and have a starting point to start asking the right questions, right? Here's an example, okay? So this is an example of big companies that already do this, right? Because we're talking about small businesses and physicians and doctors who own their own companies. You're not these big firms. This company here is GE. You guys heard of General Electric? GE, General Electric, right? So all of their financials are public information, right? Publicly traded company. So look at this, life insurance premium. Why are they giving these to their top executives? Why, right? Because, you know, retirement plans are subject to IRS limitations, right? So the matching and all that, 401k and all that has a limit, IRS limit, right? But we can unlock the limits in life insurance premiums. Also, it's a tax deduction for the company, and the executives get this tax-free, right? So it's great for everybody, you know. And so these are the amounts that GE provide for some of the, I mean, I know that these are nice and fancy, right? Lease cars and relocation, those are all good benefits. But this is actually going towards a retirement structure that is non-taxable, because this retirement is taxable, for the executives, and it's deduction for the businesses. So all the top companies, businesses, banks are already utilizing these strategies for many, many years. They've been using it for a long time. But the problem is these are big businesses with a huge team of financial professionals. That's why we want to be there for you. You know, let's say you own your own practice, a small business practice and all that. Somebody might not have mentioned some of these plans for you. And that's why we're bringing this educational series and topic so that you can be well aware that these, to take advantage of the same programs that these guys are taking advantage of.
And Lam, the price is right too.
Oh yeah. Oh, absolutely. Absolutely. And so we'll talk about that too. Some of these plans, you know, like, that have like certain costs involved with the TPAs and the CPAs and all that too. And we're going to go, we disclose all the information. We're going to go all of that. And actually, sometimes it's like $1,000 or $2,000 a year for a tax deduction of $400,000, right? And it just really makes sense. And last but not least, I'm going to share with you guys on this call that if you already own something, if you already have disability plan, or if you already have a life insurance plan or a health plan, if you already have that in place, we want to do a free review to make sure that everything is proper. I bet you that Henny and Safira always talk about if you already have an estate plan and all that, that's great. That means that you're doing the right thing for your business or your family. If you already have a trust, but it also is important to review it, to take a look to make sure that it's designed properly, right? Henny, Safira, you guys do that? Like if they already have a trust, you review it for them?
And I wanted to end with that actually. Basically, through the family wealth planning sessions that we do, Safira and I actually, we do a complimentary free basically review every year. One of the things that we do is we inventory all the assets. You know what? There's $8 billion in the State Department of unclaimed property. And it's because, you know, somebody passed away, a family member passed away, and the rest of the family, they don't know, you know, what they own. So basically a home could be missed, or a 401k, or, you know, or a bank account. So we do this, and we create a family wealth inventory spreadsheet on yearly basis to make sure that their assets are updated and their family know about it. And basically this is really something that we should incorporate, Sephora, in our yearly review.
Thank you so much, Lam. That was an amazing presentation. I mean, it's packed with information, and we would love to have you back again to, you know, like maybe clarify some things that you had to speed over, or, I mean, it was just so much information. I mean,
and there's a lot of other topics too.
I'm sure there's so much more too, right? So
yeah, because we do stuff like wealth management, and we do stuff like you know, retirement planning, and you know, like we do like retirement assets, pension plans, and how do you plan that out? And there's so many really good topics that people can benefit from, and we do it all for free. We can do, and if there's any special requests from any viewers too, they can also send messages to Henny, Safira, and all that too. Hey, I would love a topic on this, or college education for the kids, or whatever, because we do all of those things, right? Also, let me finish this slide real quick too. Okay. Is that if you don't own anything and you want to get like an analysis or a quote of your current business situation and all that, we also run that for free, right? So we'll probably ask you for some more information, like what's the setup of your business? Is it S Corp? Is it C Corp? You know, like what do the employees get paid and all that? And again, everything that you do is confidential. And we'll run a report on our end to show you what the maximum tax deductions. And you take a look at it and you say, you know what, it's not for me. No big deal. We would love to have the opportunity to at least show you that there are things available for you, right? And then we don't charge for consultation. We don't charge for sessions. We don't charge hourlies. So people come up to us and say, how do you get paid? Well, guess what? We get paid from the companies. Eventually, when the clients do business with us, from the 180 companies, they will pay us, and they'll pay us, you know, fine. You guys don't have to pay us any extra. What you can pay us is through word of mouth, strong recommendations, right? Like saying, you know what, like Henny and Safira and Cornerstone did a great job on our trust. You know, we're gonna refer them out. They did a good job on our will or planning or estate planning, right? And Lum did good on our business side of it, or a personal account. And you know, like any person like in the community that actually ask about certain things, we're going to be the first one that you recommend. So that's how we get paid, right? And you guys be the judge of it. If you have a good experience and you're happy with what you have, and throughout the years and all that, and we hope that that we work on these strong recommendations, because we don't, I don't know about you guys, but you know, personally on my side, on the financial side, we don't do advertising, we don't cold call, we don't go door to door. So we are 100% reliant on the strong word of mouth recommendations for our lifeblood of our business. So we have to do a good job for our clients in order for us to gain new clients. And so for us, we like that. We love that fact because it means that a lot of the clients put the trust in us. We have to deliver, and then we get rewarded for that, right? So the end is, I want to give my contact information. They have any questions and all that as well. That's
so
my
Lam,
personal.
are you guys working pretty much in coordination with Handy and Sephora? So because like,
Absolutely.
I know they do a lot of trust, wills and trusts for people, right? So they
Yes.
pretty much get a sense about whose life is where the businesses are at and all that stuff.
Correct.
So I imagine that, Handy, you can kind of look at somebody and say, well, wait a minute, you need to structure this way or this way or this way, right? So it's
right.
kind of like, is that like almost like a handoff?
Yes.
To Lam?
Both ways. Yeah, both ways.
Okay.
So when we have clients and all that too, and having questions on trusts and estate planning and all that, then we strictly refer over to Henny Sephora, for those cases, and then vice versa when they have financial planning questions or college savings, investments, and those questions, then they send them our way, and then we take care of them. So we're like a partnership. We work together.
I also want to mention that Lam has access to many different products, not just, he doesn't work with just one provider, and so they can really personalize, whatever.
Yeah, we do our research through all the companies out there, like mostly the top companies. I only like working with A-, A+, A-rated companies. What people don't understand is all the details behind the scene. And so that's why we want to throw in our expertise, because there's so many companies out there and the general person doesn't know what to look for, and we like to do that work for them, right? You'd be surprised. Financial, investment, and insurance companies are rated like restaurants. They have A ratings, B ratings, C ratings.
No, I would not be surprised, no.
Yeah, they have those ratings, right? Like a restaurant with a C rating is like they have a lot of infestation and rodents and all that, right? You might not want to eat there. But there are financial companies that are rated that way too, A, B, C, and all that, right? Like the scale. And I only like to choose the companies that are really high rated, and it means that they're financially strong, they're going to last for a long time, they deliver in their promises. And I have seen business owners, after meeting with us say, you know what, Lam, I'm going to go with that company. I said, are you sure? They're C rated. And I said, why do you want to go with that company? They said, well, they're kind of giving us a kickback. They're kind of giving us money under the table. And I said, that's the very reason why you don't want to do business with them, right? That's why they're rated C. And
what does surprise me though, Lam, is yes, how often I find, especially particularly in the immigrant community,
yes,
that there's a lack of understanding of any of this, and the lack of understanding of the need. So thank you for really kind of doing this, all three of you. Really, I appreciate it, because I've been on the webinars for the last 4 or 5 weeks. I'm learning a lot myself. So keep going, and I think we'll bring more and more people into listening to you guys.
Absolutely.
Nice.
Thank you for
all
that.
Right. Awesome. Thank you so much. Appreciate it. Okay.
Have a great
Thank
evening.
you. Yes. And that's my contact information too. If anyone here, I have my screen share. Yeah, contact information. You can ask questions anytime, shoot over a question, email, cell phone. If I'm in an appointment, I might not reach you right away, but I do my best to get back to you within 24 hours. And you can ask random questions. You can ask questions about a lot of different areas. And if I can't answer it, then I will definitely find or lead you to somebody who can.
Thank you again, Lam, and I really appreciate you being with us today. Appreciate it.
Yes, looking forward to working with a lot of you guys more often, and some of you guys on this call as well.
Have a good night.
Have a good night. Be safe, everyone.